Well, there's been a lot of talk lately about what this Iran deadline could mean for gold and silver, and whether what you're seeing right now is a sign that the metals trade is broken, or whether it's the kind of shakeout that shows up right before the next major move. So, in this video, we're going to separate fact from fiction, and you are going to walk away feeling a lot smarter and a lot more confident about what you're looking at on your screen. It's Wednesday, April 8th here in New York, and before we go any further, comment what day and date you're watching from. And quick note, if you value this kind of straight, no drama breakdown, support it by subscribing and commenting. John A.G. Best. So, in case you haven't seen the chatter I'm talking about, it all sounds dramatic. There's a deadline. There's talk about the strait reopening or not reopening. There's talk about threats against infrastructure. There's talk about a ceasefire, then no ceasefire, then maybe a pause, then maybe something bigger. And then on top of that, people are saying, wait a minute, if this is a real geopolitical crisis, why did gold back off? Why did silver get hit even harder? Isn't that the opposite of what's supposed to happen? That is exactly why we need to slow this down, because a lot of what people are reacting to is real. The conflict has mattered. Energy has mattered. The dollar has mattered. Rate expectations have mattered. The metals have absolutely been pushed around by this. But the jump from prices moved in a messy way to the whole thesis is dead, that part does not hold up. And once you take this apart piece by piece, the picture starts to look very different. Let me show you what I mean. The first mistake people make is they assume that war automatically means gold, up, silver up, end of story. But markets are not that simple. In real life, when a conflict threatens a major energy artery, the first reaction is not always a clean, safe haven move that lasts. Sometimes you get that initial rush, yes. But almost immediately after that, traders start thinking about oil, inflation, interest rates, the dollar, funding stress, and who needs liquidity right now? And when that second wave hits, the metals can wobble, even if the bigger bull case is still sitting there intact. That's not theory, by the way. From recent market updates, crude shot higher in the wake of the fighting and the disruption fears around the strait. And official U.S. energy forecasts have kept a conflict premium in oil, because supply uncertainty has not fully gone away. At the same time, Fed officials have been warning that higher energy costs can bleed into upcoming inflation readings, which is exactly the kind of thing that can delay rate relief and support the dollar for a while. And that matters, because gold and silver don't trade in a vacuum. If the market starts thinking, okay, this war means stickier inflation and fewer cuts, then non-yielding assets can come under pressure in the short run, even while the long-term case improves. That sounds contradictory, but it isn't. It just means different time frames are fighting each other. So what happens if this thing escalates again? My view is you could absolutely get a knee-jerk pop in both metals. That would make sense. If traders think the conflict is widening, if more infrastructure is at risk, if shipping gets more complicated, if oil looks like it wants another leg higher, then yes, people are going to reach for protection. Gold first, silver with it, and probably in a more volatile way because silver almost never does anything quietly. But here's the part I think a lot of people are missing. That spike, if we get it, does not automatically tell you what happens next. Because once the first panic settles down, the market starts repricing the consequences. More expensive energy, tighter financial conditions, a stronger dollar, slower growth, more pressure on central banks. And in that environment, metals can get sold for reasons that have nothing to do with the long-term thesis failing. People sell what they can sell, funds rebalance, traders cut leverage, governments and institutions manage liquidity. That is how you can have a safe haven asset act like a safe haven and still not go straight up in a clean line. And this is where I want to challenge one of the simpler narratives floating around right now. I do not think the only bullish outcome for metals is escalation. In fact, one of the more interesting things about the last stretch of trading is that relief headlines have sometimes helped gold and silver bounce, not sink. Why? Because when markets think a ceasefire or even a temporary pause is on the table, oil can cool off, the inflation scare can soften a bit, the dollar can lose some steam, and suddenly the pressure on metals from the rate side starts easing. We literally just saw risk assets react positively to a ceasefire headline while oil dropped sharply. And gold also found buyers as the market reassessed the path forward. So anyone telling you this is a one-direction formula is oversimplifying it. That does not mean peace is bearish, war is bullish, full stop. It means the market is juggling more than one variable at the same time. And that is why a lot of traders get chopped up in environments like this. They look at one headline, they build one clean story, and then the market trades the second-order effect instead. So let's separate the immediate reaction from the bigger setup. If we get a durable calm, or at least something that looks like durable calm, I think gold and silver could still be choppy for a bit. That would not surprise me at all. Both metals have had big runs. Both needed to cool off. Silver especially had the kind of move that invites profit-taking, weak-hand liquidation, and a whole lot of emotional trading. So even if the war premium comes out of the market, that does not suddenly erase the larger structural forces building underneath this space. And those structural forces are the reason I'm still constructive on silver. Not because I think it has to go up tomorrow morning, not because every geopolitical scare means instant moonshot, and not because I think one headline is going to magically break the entire pricing system overnight. I'm constructive because the medium-term backdrop is still very supportive, and in a few ways, it may actually be getting stronger. Start with inflation. According to the latest publicly available U.S. data, consumer inflation has cooled from the worst of the post-pandemic surge, but it has not vanished. The Fed's own March projections still showed inflation this year running above target, and the most recent PCE and CPI readings were still sitting well above where policymakers ultimately want them. That means the economy is not in a world where price pressure has simply disappeared. Add energy stress on top of that, and you have a setup where inflation can stay annoyingly sticky even if growth cools. Now layer in the war effect. Wars are not just military stories. They are supply stories, shipping stories, insurance stories, energy stories, and eventually rebuilding stories. Even when the bombs stop, the bill doesn't. Infrastructure has to be repaired, inventories have to be rebuilt, defense stockpiles have to be replenished, supply chains get rerouted, and almost none of that is deflationary. That is one of the reasons I think a lot of people are too narrow when they talk about precious metals here. They're asking, did gold go up enough this week? When the more important question is, what kind of macro environment is being created over the next several quarters? Because if the answer is slower growth, elevated input costs, more fiscal strain, and policymakers getting squeezed between inflation and weakness, that is not some terrible backdrop for gold and silver. That is exactly the kind of muddy, uncomfortable backdrop where the metals tend to keep finding a reason to matter. Now let me spend a minute on gold, because this is where people sometimes talk past each other. A lot of viewers still define a safe haven as something that must go up immediately, stay up immediately, and keep rewarding you instantly the moment the world gets ugly. But that is too narrow. A real safe haven also has to be liquid. It has to be saleable. It has to be there when someone actually needs to raise cash. And sometimes that means the very fact that gold works is the reason it gets sold in a crisis. It is sitting there. It is globally recognized. It trades around the clock. It does not need someone else's promise to remain valuable. So if an institution, a sovereign fund, or a central bank needs to mobilize capital fast, gold is one of the things that can actually do the job. That may sound frustrating if you only wanted a one-way price chart, but from a market function perspective, that is part of the point. And the official world still cares about that point. Recent reporting shows central banks ranking geopolitical tension much higher as a reserve management concern, with gold still benefiting from that uncertainty. On top of that, China's central bank has kept adding to its gold reserves, which tells you that even after volatility and pullbacks, official buyers are not treating the metal like some outdated relic. They are treating it like reserve insurance in a fractured world. That matters for silver too, even though silver is not gold. Because when gold stays relevant as reserve protection, it keeps the monetary door open for the whole precious metals complex. And when gold gets too expensive for a lot of smaller investors, silver starts looking like the more reachable alternative. Not the same asset, not the same behavior, but part of the same family trade. Now, could a recession interrupt the silver story for a while? Yes, it could. And this is one of the more honest risks in the whole discussion. If growth slows hard enough, industrial demand can cool. Factories do not consume optimism. Electronics demand can soften. Construction plans can get delayed. Capital spending can get pushed out. That is real. But here again, the timing matters. Silver does not need a booming economy forever. It needs a cycle where policy responses, infrastructure priorities, energy security, and monetary hedging all start overlapping. In other words, silver can get hurt in the middle of an economic scare and still do very well before and after that scare once the response phase begins. And what would that response phase probably look like? More fiscal support, more industrial policy, more pressure to secure domestic and allied supply chains, and sooner or later, easier monetary conditions than the inflation backdrop would normally justify. That is why I keep coming back to stagflation risk, not because it is a guaranteed carbon copy of the 1970s, but because the ingredients rhyme. Sticky prices, policy stress, political pressure, growth concerns, energy vulnerability. That combination does not usually make people feel comfortable hiding only in paper promises. There is also a psychological piece here that people underestimate. Silver spent so many years underperforming expectations that a lot of investors are trained to distrust every bullish argument. Honestly, I understand that. They have heard versions of this story before: deficits, industrial use, physical demand, supply stress, monetary debasement. And then silver would rally, stall, reverse, and leave people annoyed. So the skepticism is earned. But sometimes the reason a trade frustrates people for years is the same reason it eventually moves so hard once the bottlenecks line up. Markets build pressure quietly, then they release it suddenly. And if you look at the current backdrop, I think there are more pieces lining up now than there were during a lot of those earlier false starts. And I would add one more thing. The market is finally paying attention to electricity as a bottleneck again. Not just oil, not just gasoline. Electricity. That is important because silver sits closer to the electrical economy than a lot of people realize. Not only through solar, but through contacts, connectors, electronics, relays, circuit pathways, and the wider hardware stack that modern life keeps demanding more of. So even if one end market slows, silver does not suddenly become a single-use story. Over a full cycle, the hybrid nature is exactly what gives silver so much torque. It can draw interest from more than one buyer base. It can matter to investors, manufacturers, fabricators, solar installers, electronics demand, and policy planners all at once. Few assets get to sit at that many intersections, and that is before you even get to sentiment. Because if this market does turn the corner later in the year, silver is the kind of asset that can go from ignored to overcrowded in a hurry. It does not usually climb in a polite, well-advertised way. It tends to move in bursts, pause, fake people out, and then move again. That is why I think patience matters so much here. If your whole strategy depends on everything feeling comfortable before you act, silver is probably the wrong market for you. You have to be able to live with noise. You have to be able to live with headlines that seem contradictory. And you have to be able to separate temporary liquidation from actual deterioration. That is not easy. But it is where the opportunity usually hides. Now let's talk specifically about silver, because silver is where this gets more interesting. Silver is not just a smaller, more chaotic version of gold. It is a hybrid market. Part of the silver story is monetary. Part of it is industrial. And the industrial side is not a footnote anymore. Based on the latest U.S. Geological Survey data, domestic silver use is spread across electronics, other industrial applications, physical investment, coins, and photovoltaics, with solar sitting in the mid-teens share of U.S. use in electrical and electronics, taking roughly a quarter. On top of that, the United States remains heavily import-reliant for silver on a net basis, which matters a lot more once supply security starts becoming a policy issue instead of just a market issue. That is a big deal. Because when people hear silver demand, they still often think only in terms of bars, coins, and investor sentiment. But the metal is sitting inside electronics, switches, contacts, solders, solar applications, medical uses, industrial chemistry, and a whole bunch of systems that do not simply disappear because traders got nervous for a few weeks. And then you bring in the electricity story. One of the most important fresh developments in the macro conversation is that power demand is back at the center of the market, not as a background issue, as a front and center issue. U.S. electricity demand from data centers is now being talked about in a completely different way than it was even a year ago, with major research groups projecting a much larger share of national power consumption tied to data centers by the end of the decade, and international energy analysis pointing to AI as a major driver of that growth. Why does that matter for silver? Because when power demand gets repriced higher, the entire conversation around generation, grid build-out, efficiency, backup systems, and deployment speed changes. And when that conversation changes, solar does not have to be the only winner for silver to benefit. It just has to remain one of the fast deployment options in a world that suddenly cares a lot more about securing electrons quickly. And that is where I think some people oversimplify the energy transition debate. They act like if enthusiasm around ESG cools off, then the whole solar thesis disappears. I don't buy that, not fully. Could policy branding shift? Of course. Could political slogans change? Absolutely. Could some subsidies fade or get reshaped? Sure. But if households, utilities, tech companies, industrial users, and governments all keep facing pressure to secure dependable electricity, then solar doesn't need a fashionable slogan to stay relevant. It needs economics, speed, and deployability. And on those fronts, it is still very much in the game. Major energy research continues to show strong growth in clean energy deployment, and much of that comes down to the simple fact that solar can be scaled faster than a lot of the alternatives people like to talk about in theory. Now, does that mean solar demand for silver is a straight line forever? No. And this is another place where I think the bullish crowd sometimes gets lazy. If silver gets expensive enough, manufacturers will absolutely try to thrift it, redesign around it, or reduce exposure where they can. That is normal. Industry always tries to economize. But industry will try to use less is very different from silver demand disappears. Those are not the same claim. The more realistic view is that substitution and thrifting happen at the margin, while the broad demand base keeps expanding for reasons that are bigger than any single component choice. And by the way, silver's physical properties are still part of the story. Conductivity, reflectivity, reliability, and chemical behavior matter. That is not marketing language. Even the USGS still describes those properties as central to why silver remains widely used across industries. So yes, manufacturers adapt. But the idea that silver is just one headline away from becoming optional is not convincing to me. Now let's move to supply, because this is where silver gets tricky in a very bullish way. Most people hear higher price and assume more supply. In silver, that relationship is weaker than people think. Again, based on the latest USGS summary, U.S. mine output is small relative to consumption, the country imports a large share of what it uses, and silver production still comes not only from primary silver mines, but also from a much broader set of base and precious metal operations. That matters because when a metal is heavily tied to byproduct output, you don't just flip a switch and flood the market with more of it because the price got exciting. That is the subtle point. Silver can stay tight longer than people expect because its supply response is not always clean or immediate. If copper miners are making decisions based on copper economics and lead zinc operators are making decisions based on their own economics, silver doesn't necessarily get the last word even if silver itself is screaming higher. That makes the market more rigid than it looks from the outside. And then you bring policy into it. One of the more underappreciated developments in the U.S. is how much attention critical mineral security is now getting at the federal level. The White House and Treasury have both been pushing harder on processed critical minerals, strategic supply chains, and national security resilience. DOE's critical materials framework has also expanded the conversation beyond the old list of obvious names. Whether silver ends up getting treated more aggressively inside that framework over time is something to watch, but the direction of travel is obvious. Washington cares more about supply vulnerability now than it did a few years ago. And once governments start caring about security of supply, markets tend to reprice that eventually. Not always immediately, not always in a straight line, but eventually. Because the metal stops being just another commodity and starts becoming part of a strategic conversation. Now, I want to be careful here. I am not telling you that some overnight government stockpile is about to send silver vertical tomorrow. I'm not saying that. What I am saying is that the combination of import reliance, strategic attention, industrial necessity, and supply rigidity is not bearish. It is exactly the kind of background condition that can keep supporting higher valuations over time. And that is why I think people who only focus on the chart for the last few weeks are missing the bigger setup. Short-term traders see noise. Longer-term investors should be watching structure. And structurally, silver still has a lot going for it. Could it consolidate more from here? Yes. Could it retest lower levels first? Yes. Could it frustrate everyone and do a whole lot of nothing for a while? Absolutely. That is silver. Silver loves to exhaust people before it rewards them. But a consolidation phase is not the same thing as a broken thesis. Sometimes a market has to spend time cooling off so a stronger base can form underneath it. That is especially true after a very sharp move, because price does not only correct through distance, it also corrects through time. And time is the part impatient money hates. This is where strong hands and weak hands get separated. Weak hands look at the screen and say, it didn't go straight up, so the story must be over. Strong hands ask a different question. They ask, has the underlying case actually changed? And when I look at the underlying case, I still see a metal with industrial relevance, monetary optionality, tight supply response, strategic importance, and a macro environment that can easily drift toward the kind of inflationary mess where hard assets regain attention. Now let's talk miners for a second, because this is where people can get either very smart or very reckless. If silver prices stay elevated for long enough, the operating leverage in the mining space becomes very real. Margins can expand fast, free cash flow improves, balance sheets get repaired. And then the market starts looking at producers, developers, and smaller names differently than it did when everyone was just trying to survive. But there are two warnings I need to give you. Number one, not every silver company is actually a pure silver company. A lot of names are mixed exposure stories. A lot are jurisdiction stories. A lot are execution stories. A lot are financing stories pretending to be silver stories. And number two, miners are still equities. So if the broader market gets slammed, miners can get dragged around even if the metal itself looks okay. That is normal. It is frustrating, but it is normal. Which is why I think the smart way to approach this space is not with all or nothing emotion. It is with tranches, selectivity, and an understanding that volatility is part of the admission price. If you're successful, share your success story in the comments so others can stay motivated. Now, one more fresh point that matters here. The US economy is not collapsing right now, but it is not in some perfectly clean, disinflationary glide path either. The IMF is still saying US inflation should return to target only gradually, while the Fed's own projections show inflation above target this year. And energy officials continue to flag the possibility that Middle East disruptions keep oil elevated above pre-conflict assumptions for a while. That is not a settled environment. That is a contested environment, and contested environments tend to create opportunity in markets like gold and silver. So where does that leave us? In the very short run, headline risk still rules. If the conflict worsens, I would not be surprised by a fast move up in metals, followed by turbulence. If diplomacy improves, I would not be surprised by a relief rally in risk assets, lower oil, and a more complicated response in gold and silver than most people expect. Either way, I think the next few days and weeks can stay messy. But messy does not mean directionless forever. Over the next several months, I think the more important battle is between cooling momentum on one side and structural support on the other. And if inflation stays sticky, if energy remains unstable, if power demand keeps rising, if supply security keeps moving up the policy agenda, and if silver keeps behaving like a strategically important industrial metal with monetary upside, then the bigger move later on can still be higher. Do I think that means silver has to explode tomorrow? No. Do I think it means every dip is automatically the bottom? Also no. But I do think the odds are still good that silver has not finished this cycle, and I would be very careful about confusing volatility with failure. Those are two very different things. A lot of people gave up on this metal before the last major leg. A lot of people will probably do it again. That is how silver tends to work. It gets noisy, it gets emotional, it gets overcrowded at the wrong time and abandoned at the wrong time. And then when the backdrop lines up, it reminds everybody very quickly why it matters. So if you're asking me for the simplest version of the thesis, here it is. War risk can create short-term panic buying, but it can also create inflation pressure, dollar strength, and forced selling. Ceasefire risk can remove the panic bid, but it can also lower oil and ease pressure on rates. That is why short-term moves can look confusing. Meanwhile, the bigger silver story is still built on industrial demand, power infrastructure, import reliance, rigid supply, strategic mineral policy, and a macro backdrop that remains more inflation-prone than most people want to admit. That is the story I would focus on. Not every rumor, not every tweet, not every intraday candle. Focus on the structure. Because when a market keeps forcing people to relearn the same lesson, eventually the lesson sticks. Price can hesitate long before fundamentals do. And by the time the chart looks obvious, the easy part of the move is usually already gone for the people who waited for comfort first. And if you do that, I think the chart starts to make a lot more sense. Because silver does not need a perfect world. It just needs a world where money is uncertain, supply is tight, electricity matters, and policymakers keep getting boxed into awkward choices. Look around. That world is not hard to imagine at all. And one final point before we wrap this up. I know there are people out there who want some dramatic event to break the whole system in one shot, because they think that is the fastest route to insane prices. I don't think that is the right way to look at it. Disorder is not some guaranteed gift to holders. Broken markets create broken liquidity, broken price discovery, broken rules, and political reactions you may not like. What you actually want, if you're constructive on metals, is a market that keeps repricing higher because the fundamentals keep forcing it there. That is a much healthier outcome than chaos for the sake of chaos. So yes, stay alert here. Yes, watch the headlines. Yes, understand the next move could be violent. But do not let short-term confusion talk you out of a longer-term setup that still has a lot of fuel behind it. That's how I see it. This is for education and market awareness only. It's not personal financial advice. It's not a buy or sell instruction. And you should always make decisions based on your own risk tolerance, your own research, and your own financial situation. Take care of yourselves, take care of each other, and I will see you in the next video.